Hello and welcome back to another Sigma Max Capital video. And today I've got a new topic. I kind of came up with this, on the spot today. I've seen, I thought, all right, first off, disclaimer, guys. The following content is for educational and informational purposes only and reflects my personal opinions and insights. It is not financial advice. I'm not a licensed financial advisor, and nothing in this video should be interpreted as a recommendation to buy, sell, or hold any financial assets. Always conduct your own research and speak to a qualified advisor before making any investment decisions. Investing involves risks, and you may lose money. Past performance is not a guarantee of future results. Okay, and with that, today's topic is lower oil prices are bullish offshore? Question mark. Um, so I thought let's take a look at the markets today. So President Trump came out with news that he's going to be tariffing the China 104% now, and that goes into effect. I think it's already in effect actually. And so if we take a look at the price of oil, we're at $60, which is pretty mental. I mean, let's look back over the year. I mean, look at that drop. So this is all based on these tariffs, and we're at like $80 at the start of the year in January, so it's quite a big drop, and there's a lot of volatility involved with all this, and so yeah, basically, you know, this presentation is kind of um, well, basically, I want to make a case for it. So the global oil supply, this is from 2023. Offshore oil represents around 30% of the market, shale 10%, and onshore is 70%. And the reason we've had such low kind of prices um, over the past few years, decade, 15 years, is because of shale growth. So before that, if you look at the price of oil going back in the early 2000s, and then you compare that to inflation, oil would be far higher. And we peaked in 22 at about $120 a barrel with the invasion of Ukraine. And if that were to happen again and you inflation adjust that, it'd be even more, guys. It'd be like $140 plus. But as always, politics is involved with this, and governments don't want oil to be that high. They want it to, President Trump, he's going to want it to be somewhere. He doesn't want it to be too high, but not too low. Kind of 60, I'd estimate in the $60 range because he wants it to be low enough where things are affordable, petrol, things like that. But at the same time, he wants um, American oil to be profitable. And so, yeah, so currently offshore, about 30% of the oil supply, shale 10%, and onshore 70%. So with that in mind, you know, we have to talk about break-even costs. Sorry for the spelling mistake. So offshore break-even cost is around $43 a barrel, which is quite low. Um, Shale is anywhere from 45 to $66 a barrel, but in the Permian, it's $65 a barrel. But if we go back to the oil price today, it's tanked. It's only $60. So that's now made a lot of onshore or shale in the Permian unprofitable. So we'll have to see where the oil price goes from here. Obviously it's just based on news. There's no actual data. People are just estimating these things. But, it's something to bear in mind. Offshore is a lot um, cheaper cost per barrel. And, as well as this, to go on top of it, we there might be a slowdown in shale because, if you look at this chart, it's not grown as much as it historically has. And, it's I hear through other people that the Permian is getting a lot gassier. Um, so that's just another thing to bear in mind. This is all this is a case for offshore. And what I'm basically saying is with a lower oil price, it will make onshore less profitable, but the barrels of oil have to come from somewhere. And I think we're going to have growth in oil. in terms of global demand. If you look at a lot of countries in, Asia, Africa, you know, around there, that India especially, like they need loads of oil, and yeah, it's something to bear in mind. I think, we have to get the oil from somewhere basically. And the way offshore works is, these companies, Petrobras, Shell, Exxon, Chevron, they all contract offshore drillers to drill um, deep water wells. And, it's kind of based on day rates. I think there's somewhere around $400,000 a day now. Once they get up to 600,000, that could be this. I think we're in the early stages of the cycle for offshore anyway. So this is just one of the stocks that I'm kind of interested in, and I think it looks quite promising. Is Transocean? Yeah, it's Swiss based, I believe, and the ticker is RIG. So the current market cap of this is 2 billion. This is just some, you know, back back of a napkin kind of quick maths, but the market cap is 2 billion. Net assets kind of replacement cost of these rigs is about 10.28 billion. So if you kind of discount that, that's a 79.8% discount. So, you know, let me show you the ticker. So this is kind of um let's just see the chart. It'd be useful. So yeah, it's the reason this one is quite volatile compared to the others like Valaris is quite leveraged on debt. It didn't a lot of the other companies in the past cycle '08 things like that, they filed for a Chapter 11 bankruptcy, but Transocean was the only one who didn't. So here we go. So um, good 5 years. So if you look at, I think July 23, I mean the stock got up to $8.50. Um, and yeah, this is a highly cyclical industry, by the way. So, it's all based on day rates, as I've said already. Let's look at the chart. So yeah, that was during 2007, I believe, and it went up like it, it went up a lot anyway. But yeah, I think we're still in the early stages of the cycle, and so anyway, the point is the stock is currently 2.16, $2.16 a share. And if you apply just the discount rate, that puts you somewhere around $10 at the current price. I mean, let alone day rates going up, things like that. I could see uh, you know, this is what I mean. Like this is a proper Buffett style business because these offshore rigs, they're not really being made. They're expensive. Nobody's going to build these. You've got a moat around the business. And with shale becoming less profitable with a low oil price, these could do very, very well. And so I believe this is, it, it looks good. That's the point. Um, but yeah, so that's kind of all I had to say about offshore. I think I thought, maybe let's talk a little bit about the markets today because uh, it's pretty mental. How do I go back to just look it up again? Um, yeah, I mean, Chinese tariffs 104% starting tomorrow. Um, yeah, look at oil. It's below $60 a barrel. I mean, when was the last time it was like that? I mean, what 22? So that's 3 years. And I mean, think about inflation over those few years. It was like 7%, 22 or something. Um, but yeah, it's quite something. I've kind of wondered as well whether the current um, the oil price and these tariffs, I wonder if it's sort of a strategy that President Trump and the White House are using to stop the war in Ukraine as, you know, for Russia, how they're financing their war through selling oil, and with the price dropping so much, um, yeah, it just seems something. something to keep in mind. It could be a bit of a negotiating strategy for the US. Um, but yeah, that kind of sums up today's video. I hope you enjoyed, maybe learned a bit. As always, not financial advice. It's just a bit of, bit of my, it's just my opinions. Yeah. Um, Thank you for listening, and I hope you have a good day. Bye.